First Financial Bancorp just dropped an absolute monster of a quarter, completely beating consensus. I mean, we are talking a record-adjusted EPS of 80 cents.
Yeah, that is a huge print.
Right. And unadjusted came in at 73 cents, which drove net income to a massive $76.5 million for Q2 2026. So for you, the retail investor listening today, we are skipping the pleasantries and digging right into how they engineered this and how the market is reacting to their guidance.
And, right alongside those headline earnings, their net interest margin, or NIM, came in at a really robust 3.98% on a fully tax-equivalent basis.
Which is incredibly strong.
It is.
Yeah.
And management's guidance assumes that this margin is going to remain stable over the near term, assuming, of course, no crazy interest rate shocks. Plus, they expect loan production to stay really healthy right into the third quarter. The stock reaction so far shows the street is absolutely buying into this growth narrative.
Let's pause on that 3.98% margin for a second, because I know we just threw out the phrase fully tax equivalent basis.
Right.
For anyone just looking at the raw yield on the income statement, how did they hold a margin basically knocking on the door of 4% in this environment? I mean, the yield curve has been brutal for regional banks.
Oh, it's been a nightmare. But the underlying mechanics here, it's really a masterclass in balance sheet management. So the NEM actually saw a tiny 1 basis point decline from the first quarter.
A single basis point.
Right, microscopic. And to understand it, you have to look at the asset and liability tug of war. On the asset side, their yields actually dropped by 7 basis points.
Okay, so loans are yielding less.
Exactly. But they successfully buffered that because their funding costs, the interest they pay out on deposits, dropped by 6 basis points.
Oh, wow. So they matched the drop in loan yields almost perfectly by just paying less on deposits.
Basically, yeah. But that 1 basis point decline, there is a very specific narrative hidden in there about loan accretion that we really need to unpack.
Yeah, because management called out a 5 basis point dilution specifically tied to lower than expected mortgage prepayment rates, right, on their acquired loans.
Exactly.
Which, I mean, let's translate that for the listener, because loan accretion dilution is intense accounting jargon.
It really is.
Basically, when First Financial buys another bank, they mark the acquired loans to fair value, usually at a discount. Say they buy a loan for 90 cents on the dollar. As the borrower pays it off, the bank claims that 10-cent difference is interest income over time. That's the accretion.
Right, and the speed of that extra income completely depends on people actually paying off their loans.
Which nobody is doing.
Exactly. In a normal world, people move, they refinance.
Right.
But right now, with higher rates, nobody's giving up their 3% fixed-rate mortgage from 2021.
Right. So the borrower just sits there, the mortgage stays on the books forever, and that discount has to be stretched out over a much longer timeline.
You got it. It's just a mathematical drag. And it pulled 5 basis points right out of their net interest margin. If people were moving at normal historical rates, First Financial's margin actually would have expanded this quarter.
Which is wild to think about. But, while the net interest income story is clearly a huge win, it kind of makes the fee income side of the house look a bit, sluggish.
Yeah, it was definitely softer.
Because management flat out admitted that adjusted fee income, which was $71.9 million, came in below expectations. What was the drag there?
So after a really strong Q1, they saw a dip across a few specific non-interest income lines, mainly lower foreign exchange income, which was down to $13.1 million. And they also had lower swap income and investment banking fees.
To be fair, though, those are notoriously volatile line items, right? They aren't steady annuity streams.
Oh, they're highly transactional. I mean, they're tied directly to commercial client confidence. If a client is nervous about the macroeconomy, they might delay an acquisition or, hold off on a complex interest rate swap.
Right, which totally pauses the fees for First Financial.
Exactly. Management did note they expect a rebound in the third quarter. It's usually just a timing issue of when deals actually close.
Well, and I want to push back on the whole negative fee narrative anyway, because if you look past that volatile capital market stuff, you see their leasing business.
Oh, the leasing segment is great.
It's an absolute bright spot. It grew 5.3% from the linked quarter to hit $22.8 million.
Yeah, the leasing business is a phenomenal diversifier. Think about it. A manufacturing company always needs forklifts and trucks, regardless of whether the M&A market is hot or cold.
Right.
So when investment banking takes a breather, having this steady, growing commercial leasing segment It really smooths out the earnings volatility.
Right, it keeps investors from getting spooked. But still, because overall fees were soft, they had to protect the bottom line somehow. You can't just tell Street you missed on fees and shrug. So they took an axe to expenses.
They really did. Non-interest expenses fell 3.7% from the linked quarter down to $161.5 million, or $149.1 million adjusted.
So how did they pull that off? Just lower commissions from the lower fees?
Partially, yeah. Lower compensation costs, reduced commissions, lower payroll taxes. But the deeper story is the realization of their M&A synergies.
From the recent acquisitions.
Right. They announced that virtually all of the cost reductions from the Westfield deal are now fully realized. That integration is basically done.
Oh, okay.
And the savings from the more recent bank financial acquisition, those are phasing in right now and will be fully realized by the end of Q3.
And for the listener, when we say realizing a synergy, that's basically corporate speak for firing duplicate roles and cutting redundant software after a merger.
Exactly. You don't need 2 HR departments or 2 core banking systems.
Right, and shedding that dead weight means their adjusted efficiency ratio pulled down to a super lean 56.8%, meaning they only spend about 57 cents to generate $1 of revenue.
Which gives them incredible operational leverage.
Absolutely, and that efficiency bridges us perfectly to the balance sheet because they are playing aggressive offense here. I mean, First Financial delivered $240 million in loan growth this quarter. That's 7.1% annualized.
It's a massive number.
It is, especially considering the macro backdrop, right? Most regional banks are terrified, they're hoarding cash, tightening standards, pulling back. But First Financial is just taking market share.
Originations were actually up 23% over the first quarter.
Okay, but I have to play devil's advocate for the retail investor here. Is it possible they are acting recklessly? Are they sacrificing credit quality to get 7% annualized growth right now? It feels like they might be taking the risky loans everyone else is smartly rejecting.
That is the exact question regulators and institutional analysts ask. But the data tells a completely different story. Net charge-offs the loans they actually had to write off as losses declined by 15 basis points.
Wait, really? Declined?
Yes, down to a mere 0.20% of total loans.
0.1%. That's basically nothing.
It's negligible. They aren't taking on highly leveraged buyouts or sketchy commercial real estate. They are picking up prime commercial and industrial loans from good businesses that other banks are just too capital constrained to fund.
And they're still provisioning for it, right?
Exactly. Their allowance for credit losses is sitting at 1.38% of total loans. So they are aggressively growing, but still building up the rainy day fund.
Textbook execution. But, I mean, to fund $240 million in new loans, you need cash, you need deposits.
And they got them. Average deposits were up, but the real story is core deposits. If you strip out brokered CDs, average core deposits increased by $168.6 million.
Which is huge because brokered CDs are just hot money. It's mercenaries chasing yield.
Right. The second a competitor offers a fraction of a percent more, that brokered money is gone. But core deposits, checking accounts for local bakeries, payroll accounts for manufacturers, that's the lifeblood of a bank.
It proves the franchise value. And all of this, the margin, the expense control, the pristine credit, it drives capital. Tangible book value per share rose 3.8% sequentially to $16.64.
That is a massive sequential jump for TBV.
And it gave the board the confidence to bump the dividend up to 26 cents a share.
Well, when you generate capital that fast, you can hoard it, return it to shareholders, or use it to buy competitors.
Which brings us to the monumental news of the quarter. They aren't just growing organically, they're using this capital fortress to acquire Finward Bancorp.
Right. It's an all-stock transaction. First Financial is buying Finward, which is a holding company for People's Bank over in Munster, Indiana.
Okay.
They're exchanging 1.35 First Financial shares for each Finward share, valuing the deal around $208 million.
So let's use an analogy here for you listening to visualize the strategy. Think of First Financial's recent expansion into Chicago like a high-end restaurant. The commercial loans are the expensive, high-margin steaks. But to fund those, you need cheap ingredients. Cheap core deposits.
I love that analogy.
Right. And Finward is this 116-year-old Indiana community bank. They are the low-cost supplier of those ingredients. They bring 24 locations, $1.7 billion in deposits, and it expands First Financial's Chicago MSA deposits by a staggering 75%, pushing them over $4 billion.
The strategic logic is bulletproof. They're basically bolting this low-cost Indiana deposit engine onto their Chicago commercial vehicle. And the financial metrics are highly favorable. It's expected to be 5% accretive to EPS.
Meaning the new earnings from Finward more than offset the new shares First Financial has to print to buy them?
Exactly. And the most scrutinized metric tangible book value dilution is estimated at a very minimal 0.4%.
0.4%. That's a rounding error in bank M&A.
It is, which means the TBV earnback period is an incredibly fast 0.6 years. Anything under a year is considered an absolute financial home run on Wall Street.
Sure, a 0.6-year earnback looks perfect on a spreadsheet, but deals fail in reality. What are the forward-looking risks here that could derail this?
Well, the filings outline a few. First, inherent operational risks. Integrating 24 new branches and completely different core software systems is a logistical nightmare.
Right, if the banking app crashes for 2 days during the changeover, those deposits will just walk down the street to a competitor.
Exactly. There's also the purchase accounting risk. First, Financial has to mark Finward's entire $1.5 billion loan portfolio to current fair value.
Which is tricky right now.
Very. If the credit marks are worse than anticipated, it totally alters that beautiful accretion math we just talked about.
Plus, the macro variables. That 3.98% margin relies on rates staying stable. And that pristine 0.20% charge-off rate relies on consumers staying healthy. If the regional economy stumbles, credit costs rise, and that eats into the capital needed for this very integration.
And of course, the deal isn't closed yet. It still needs Finward shareholder and regulatory approvals, expecting to close in Q4 2026.
Right. So First Financial is clearly systematically building a regional powerhouse in the Midwest by just swallowing smaller banks. But the deeper question for you to explore as an investor is this. Can their M&A playbook continue to scale efficiently? Or will the gravity of the highly competitive Chicagoland market eventually cause the acquisition indigestion that plagues so many other growing regional banks? Follow the show for daily earnings coverage.